before we get too far along, I want to talk about terminology. One of the interesting things that happened in the discussion that wasn't recorded, or won't be in the recordings earlier, Michael told everybody he was a broker. I immediately went to effectively stockbroker. I assumed and then even when he corrected me effectively, because he knew what I thought, said private transactions, I immediately swapped him out. I said, okay, you're a day trader. That was where I went, because that language is used in that way, and in the bit of the market that I spend most of my time, I would have understood a broker to be somebody who works for an investment bank or for a brokerage house, maybe acts under a sub-license under the Australian Financial Services licensing regime to deal with private clients or their own investments in that way. Where in fact, Michael is a business broker. So my guess is that you have a licence under the Victorian real estate legislation. So this is kind of an interesting thing.
Which is weird.
It is weird.
It's a bad place for it to sit, but that's where it is.
No, well, and again, it's kind of an interesting discussion point here too, that so we don't none of the topics directly sit on the licensing regime, but we will keep coming back to the licensing regime over and over again. And the reality is that there are laws that attempt to protect consumers of financial products. And where it starts to get difficult is, what is a financial product? And this is part of the discussion that we're having. So a share in a company is a financial instrument. Is it a financial product? A company and a business are not exactly the same thing, but from the point of view of the people who work in them and the owners of them, they are the same thing. And so actually being very precise about the language and thinking about what licensing regime impacts the way that your clients can be advised becomes an important question here. So the way that the law has effectively evolved is that buyers and purchasers of shares in companies that are publicly traded are effectively protected under an Australian Financial Services licensing regime. But where there are single transactions, so where we're talking whether they're public or privately held companies, where we're talking about companies that are sorry, I'm losing the track of my thought. We're talking about one buyer and one seller, or a very small number of sellers and a very small number of buyers. They're private off-market transactions. They ultimately are usually assisted by brokers, not always. In fact, actually, what do you reckon it is?
I'd probably say it's 50-50.
About 50-50 to have brokers involved. And it just depends on the industry and the process and how people have found a purchaser for their business. And ultimately, brokers are, business brokers in that context, it's state by state by state, and they're regulated under effectively the real estate legislation. So similar rules for buying and selling real estate. So do you actually have a real estate qualification as well? Do you have to maintain that?
We have to maintain that.
Yeah. Do you use it at all?
No. I mean, that's what's perverse about it. It doesn't really belong in that category.
No, and they're quite...
category, they wanted to shoehorn it,
Yeah.
obviously, at the some regime. So that's why.
Yeah, and it's also, some of the complexity is it's state regimes as opposed to the federal regime, which is where the financial services stuff comes from. So it's interesting that they fit in those gaps. And sometimes this can be an issue for lawyers as well. Lawyers who regularly practice in this space often will recognise synergies, a word we're going to use quite a lot, between clients, or opportunities where they will see, okay, I've got this client who's run a printing business for the last 30 years. It's a family-owned business, but the third generation, there's no obvious successor, and grandpa needs to go into a nursing home. It was a business he built up. So the second generation want to sell it. Often you've got the complexity of one family member running the business, some other family members who are still getting dividends from it or something like that, but not actually involved in the business itself. And then it might be that the firm has another client that's growing their 3D printing or their digital signing business or something like that, and they can see a synergy in putting those two businesses together. Lawyers actually have to be careful not to do things that you need a license to do as a broker, and to only do the things that you do have a license to do as a lawyer, which also includes, in that kind of situation, managing conflicts of interest. And that kind of stuff happens particularly in the middle tier commercial firms all the time, that first level complexity in understanding that. So let's start with the basics. I don't want to bore anybody too much. So I've just realised that I've made my notes big for the slide that we can't see yet. Let me just make my notes big for the slide we can see. That'll be better. So I'm going to start with M&A. Most people, this subject is called acquisitions, takeovers and mergers. Don't know why. It's universally referred to as M&A, mergers and acquisitions. Everybody talks about it like this. When I was asked to teach it, I was asked, could you teach a subject about M&A? I'm like, yeah, of course I could. And I came in and saw it was a subject that was actually about contested takeovers and thought, yeah, we need to change that. And which has gone much more back into the M&A space now. So M&A is a really loosely used term. These really, most times we are talking about a takeover in the sense of a purchaser buys an interest that ultimately ends up with that purchaser having control over the resulting entity. So law firms love to use the word merger. Any of you who work in law firms and have been through a merger? Have we got anybody who's been through that? And we often use the word merger, and often the resulting entity has a new name, which is some blending of the acquiring firm's name and the purchased firm's name. But ultimately the transaction is usually an acquisition and a sale. So another word for takeover is sale and purchase, really. But the end result, even though we often call them mergers, because the businesses have come together, there is technically an acquirer and a vendor. We use M&A or mergers and acquisitions to include transactions that involve restructuring as well. Somebody who styles themselves as an M&A lawyer will also do things like demergers, divestments, or also using schemes of arrangements to either spin out or to close down a type of business. So it's a very broad catch-all term on the whole. So technically, as we go through, we're going to try and be precise, and we're going to talk about mergers, which effectively in Australia can only happen under a scheme of arrangement, which again you will deal with in a lot of, well, if you do the insolvency elective, schemes of arrangements will be looked at from the point of view of an insolvent transaction. But schemes of arrangement can be used to remodel or change the way that a firm is comprised. An acquisition and its twin divestment is the sale and the purchase. It includes takeovers. Generally, we refine our understanding of the word takeover to mean an on or off market transaction involving a listed company. And we'll talk a little bit more about what that means. But a sale and purchase of a business or shares is often referred to, again, by the party who's doing the acquiring as an acquisition, and not surprisingly, by the person who is selling. If the group is going to continue and they are just selling a business, they will usually refer to it as a divestment. But when it is an exit strategy for the owners, where they will, something that they own will no longer belong to them and be run by somebody else, and they will just have money and their hobbies, we usually refer to that as a sale. Again, there's no, this is jargon as much as anything, but you can tell from the way that the language people choose what kind of transaction that they are talking about. Come on, what's going on here? No, apparently clicking aggressively does not help. Okay, I just need to shut that down, and now we should be right. There we go. All right, lots of other transaction types. Leverage buyout, management buyout, spin-off, carve-out, IPO, private equity. Let's have a chat about them. Leverage buyout, what do we think that means? Anybody want to share?
High debt financing.
High debt financing. So effectively, a leverage buyout will be a transaction that involves the purchase by somebody of an asset, or which might be a company or a group of companies, and they will fund that using debt. So the purchase price will effectively be paid by debt, and the security for that debt will be the assets that they have purchased for the most part. So in an LBO, it is very rare for the purchaser to front up a significant amount of capital. Sometimes, particularly pre-GFC, they might not have fronted up with any capital of any meaningful sense. MBO. Easy one. What's management buyout?
Management buying the company?
Yeah, effectively, a company, often this happens when you've got a group of companies. So a group or a conglomerate might be doing a range of different types of business, and they decide to use a different term, spin off or carve out a particular business. So it's no longer core to their strategy. And so in order to do that, they might engage a broker to go out into the market, and we'll talk about this in the next weekend a little bit more about the different ways that they might put it up for auction effectively to do an auction sale. But often a really good potential purchaser is the management team, because the senior management team often, if that business is carved out, they're then looking at a whole new employer, a whole new boss, a whole new investor. They're the ones who know the business the best. And so often an MBO will actually be significantly leveraged, because what the brokers will do is work with the management team to find out firstly whether there's an appetite for that management team to purchase the business, and then secondly to work through whether or not it can get funding. Just jump in, just loudly.
The management team that you're speaking about is the management team of the prospective
spun-off business.
Gotcha.
Okay, so if you have a business, and for reasons known only to my subconscious, we're going to pick a robot business this time, a business that builds robots. We're going to use as a continuing example to start as we go. So if you were a company that built machinery for production lines, maybe you're a 100-year-old company that was initially started by a fitter and turner somewhere, and you built production lines, and over the years you became more and more technical, and you created bespoke robot automated production lines for building vehicles. But, lots is happening in that autonomous space, Industry 4.0. There are all sorts of things that are happening. And you know that you are just a simple fitter and turning company and you want to stick with your key business. So you might think, actually, the cost of investment in our robot arm right now is very, very high. We need significant investment there to keep up with everything that's happening with our competitors. We would be better off spinning out that business and buying in that expertise when we need it. It's a perfectly reasonable strategy. But if I was the CEO or the managing director of the subsidiary company that ran the robot arm, I'm thinking, well, when you sell a company, I need to go. Because my expertise is in robots. It's not in production lines or, the fitting and turning or wherever that came from. And so the question becomes, well, do I want to now work for Google or, I don't know, whoever it is who's doing the most work in the world of robots right now? Do I actually want to be part of their machine? Or we can see the opportunities here. I've got a great team. I've worked really hard to get this business to the point that it's at. Maybe the team and I can go out and borrow some money. We already know the business. We've already been developing the strategy. That's what we can do. Okay, makes sense. I've got robots for the example as we go on. Okay, IPO.
Usually where a company decides that it would like to list on the share market and have its shares or other securities available for trade.
Yep.
Usually it'll be offered to retail and institutional investors, and it's a way of getting that initial capital.
Yeah. Absolutely. So it is exactly as it says, initial. Interestingly, technically these days, and we'll move through because there are so many new ways over the last 5 or so years that you can effectively offer shares to the public. But usually we still use the term IPO to attach to the idea that we are offering the opportunity to buy shares in this company to the public, and we are going to list on the stock exchange at the same time. So, interesting you note, I keep defaulting to the word the stock exchange. We actually have more than one stock exchange in Australia. When I refer to the stock exchange, I am usually referring to the ASX, the Australian Stock Exchange. It itself is it's a listed company, and it basically operates an exchange. Much like Facebook operates a platform where people can share information and photographs about themselves, the stock exchange is simply that, a platform where people can offer shares for sale and make bids to purchase shares, and there are a set of rules around that happens. So technically, ASX is a technology company. It provides software and a technology platform that allows for the sale of shares. It also provides a function where it regulates the way which shares are publicly traded. So again, we'll delve into the rules and how it's quasi-regulated role as we move forward. Private equity. What's a private equity deal? And what do we usually mean when we use those terms?
It's a private company with private funders looking to invest.
Exactly. A private company, in fact, technically a lawyer would say a privately held company. The company itself might be technically a public company for a range of different reasons, but it will be closely held, as in it will have shareholders who know each other and who are, if they are not in fact family members or close friends or previous partners who treat each other as partners, it is quite likely that they will have a shareholders agreement of some sort. And and effectively a private equity deal will usually involve the sale of 100% of the business itself. Not always. It might be involve an incoming investor of some sort, or effectively the merger. It might be that I find another small robot company that is closely held just by, Elon Musk and two of his Victorian-based friends, shall we say, and I basically decide, the management team agree, after we've done that MBO, that we will exchange our small number of shares in our small company for shares in this Elon Musk's company. We will then, it's technically a sale and purchase. We are buying shares in Elon Musk's company. The purchase price is shares in the company that we have just sold. The company that we have purchased, assuming it's an issue, the company that we have just become shareholders of is now the parent company of our little robot company here. That is one transaction. Don't worry, we'll map these kind of ideas out. What makes it private equity is that it's happening in this small space and that it's all closely held. People know each other, they recognise each other's faces, and they often are parties to shareholders' agreement. We also have we also use this term when we use private equity venture companies. So you will have heard about PE deals or private equity deals that were particularly significant in the lead up to the GFC, but substantially following. Some of them are very big deals. So private equity firms, so they're effectively investment banks, will identify deals where they will often find listed companies and they will do a takeover, usually not a contested takeover, or very rarely a contested takeover, that the board will recommend in favour. There'll be a scheme of arrangement of some sort. They will finance the deal, they will take a company off market, they will restructure it, change it, and then they will either sell it or relist. So some famous examples, Myer. Yeah, Coles Myer is a really good example. Sorry? MYOB is another good example.
But my former employer, Crow, that happened to them, Index took them over.
They did too. So you see the deals all the time. So again, so it's just coming in. Often the one I was going to go with, I was thinking about Coles Myer in particular. So that started as, and then they basically realised that by selling back, they sold Coles back into Westpac and then subsequently listed Myer. So Coles Myer was one listed company. It then came completely off market. Then Coles got sold to Westpac. Sorry, not Westpac, Wesfarmers. Wesfarmers was effectively PE. There was private equity investment that made that deal possible. Then Myers was relisted as a company with significantly less success than Coles. Then subsequently, Coles has been spun out of Wesfarmers as a separate listed entity again. So again, we could use that as a good case study as we go.
I reckon it's the biggest Ponzi scheme.
You are not alone. So Michael said he thinks it's the biggest Ponzi scheme.
What they do is just basically they restructure the balance sheet, make the revenues look good, expenses, they will fire a lot of people, make it reasonable, and then they just basically sell the shares. Mine is a good example. As soon as the sold shares on the market, it's just went downhill from
But the brochure had a really good cover.
Yeah, exactly. Yeah.
Very nice cover
But
page.
it is, it's great.
And they throw a very good party at the end of their deals, and there's usually very expensive champagne, and those guys make a lot of money. But yeah, no, look, I think there's been a lot of criticism, and one of the themes that we will talk about a lot as we go through this this course is about disclosure and the extent to which the differences between private and public transactions, and the extent to which the ultimate investors in most of these large deals, particularly in Australia, are mums and dads. because the way that we have a large and active share market, some of the biggest companies in the world by share value and share trade volume are Australian companies, BHP, Rio Tinto, and others. And because Australia has compulsory superannuation, and because superannuation, significant proportions of it are invested in the share market, and also because Australia has a 4 pillars banking policy and the banks themselves also invest in the share market, people, ordinary Australians, are much more exposed to these large transactions than you might otherwise think. And there's very little information available about them. But it's also, they seek out very little information about them. But particularly the private equity ones, the extent to which there might be insider information, and we'll talk a little bit about what that is. Those people who've done company law, how much do you talk about insider information? Quite a bit. Okay, good. That's my expectation. But the insider, because I'm not going to go through it in detail, but other than let's actually look at opportunities where there could be differences between insider and outsiders, or transparency issues. But also, I think we need to think about the extent to which the mechanisms for informing the market, particularly when deals transform from private equity onto the market, are we getting the kind of information that we need to make sense of the deals? Or is it just the magic of the numbers, as Michael suggests? And what the solutions to that might be. And that, ultimately goes to the crux of one of your most significant assignments, actually. So,
The rule of thumb is if it's very easy to get shares in the IPO, be worried. The harder it is to get shares in the IPO.
The more the advertisers, just be wary of it. If it was too good, they basically will be, it's like if they're advertising it's more than that, avoid it.
yes. I think that's a very good rule. Okay, so overview. Public M&A, we're really talking about listed company transactions. So involving that, in order to be a listed company, you need to be technically a public company, but we are talking about listed transactions. And in a private M&A sense, and that's the vast majority of transactions that are actually happening, we're looking at closely held non-listed entities. Again, they might be technically public companies, and you need to think about that. So, merger, we've already really spoken about this catch-all type word. Demerger. What do we think a demerger is?
It's when a company says, okay, we've got this business and we've got this business, and well, we think they're better off on their own.
Yep.
So they split the business.
So they split them out, absolutely.
The example is BHP and BlueScope.
Excellent. BlueScope or OneSteel as well. The same idea. And effectively, predictions are that we will see more and more demergers in the Wesfarmers and Coles is another one. We will see more, particularly in an age of disruption, because as large groups address risk by putting disruptive or new business models into separate entities, then they have the opportunity to split them out. So again, we could call it a split out, we could call it, we can use other words. We tend to, it's important to know demerger in part because tax office, often the rulings use that language of demerger. And if we're looking to see whether there is a rule that applies to what it is that we want to do, then actually using the same language that is used in the legislation helps us find the things that we need to do. So spin off, I think I just said spin out, but spin off is more Acquisition, I think, makes sense anyway. It's really any transaction that involves the acquisition of assets. And we'll explore the difference between acquiring assets, as in a business sale and purchase, as opposed to a share sale and purchase. Now, it is interesting, in the industry, we tend to use the term business sale and purchase for smaller transactions, even when the transaction is actually modelled as a share sale transaction. I don't really know why that is. It's just habit, I think. I think up until probably until capital gains tax really took hold. So from the capital gains tax regime came in 1985. Yeah. So if you hold if you have an asset that you have held since before 1985 and you sell that asset for a profit, it's effectively a tax-free profit. Subject to more, yeah. Like I said, it's all about the gap. Very high level. So for the first 10 years or so after capital gains tax came in, if you were selling your business, it was made more sense for the most part to sell all of the assets that were needed to run that business, because you could sell them for a profit, particularly if there was land in that mix, without actually having to pay tax significantly. However, if you sell shares, you have to pay tax effectively. And if those, well, again, it doesn't kind of matter, but let's use that as a carve-off. From about 10 years afterwards, it became much more popular to sell companies by selling all of the shares for a number of reasons. One is, from a purchaser's point of view, you know you're getting everything, because if the company owns everything, you get everything the company owns. Downside is you also inherit all of the shit. That's a technical M&A expression. By the way, you cannot be an M&A lawyer without swearing quite a lot, and a lot of the jargon is incredibly misogynistic. And sometimes I even use it. I don't know, initially I thought it was empowering, now I'm just in a bad habit. But yes, so there's weird jargon that people will use all the time that, anyway.
And that risk piece with acquiring shares, inheriting all the liabilities as well, the smaller the transaction, the more of an issue that is.
Yes, yep.
Because why bother? It's not worth the hassle. It makes the contractual side.
So we'll come to that. I'm going to stop you because we will do an exercise precisely around that, but in that broad sense. But from a tax perspective, for a vendor, if you have owned a share for more than 12 months, so it's been held continuously for that period of time, you pay half as much tax as you would if you had held that share for less time. So it basically halves your capital gain. So again, that can be taken into account in structuring the price. So it is actually these days, especially once you get to the 5 million mark or more, quite rare to have a straight old-fashioned sale of assets, sale and purchase of a business, the way that old-fashioned lawyers like me would think about that structure. It would be structured as a share sale and purchase, but they tend to be referred to as a business transition or a business sale at that lower price end. So, again, this is why I don't like slides, because I kind of have the conversations as they come up. But bidder and target, again, two phrases that we will come across more in the takeover term. Once you're actually negotiating, even when an agreement hasn't been set, we do tend to talk about vendor and purchaser, or seller and purchaser. We might use, while we're in an auction stage or there are competitive bids that are available, even in a transaction, a private transaction, we might use the phrase potential purchaser. But we tend to, the language in draft agreements, the language in term sheets, etc., tends to use that approach until we get into the takeover regime. So even though most sale and purchase transactions have a kind of auction format, we don't really use the term bidder. And when I say auction format, I'm really talking about a Dutch auction as opposed to it's very rare, if ever. In fact, I've never been involved in a transaction where there was a sale of business where people got into a room or stood out in front of the business and there was an auctioneer actually doing auctioning. But we call it an auction concept in the sense that the broker is basically gathering bids, putting together the different proposals so that they can be weighed up by the vendor. Target, rarely used outside of a takeover transaction either, unless it is very early planning stage where you have got a group that is strategically looking to acquire a particular type of business. So they might talk then about a potential target, often before they've even approached anybody. It's at that strategy stage. Again, for any of you, who are working in the areas, if you disagree with the way that I'm using language, let's have that conversation, because again, I'm not as active in these spaces as I was 7 years ago when I started teaching this subject. Takeover is generally used in the context of the acquisition of a majority interest, but it can refer to any kind of takeover, transition of control. So when the end result is a takeover, for internal reasons, particularly when you are needing to go through a change process with employees, organisations tend to avoid using the term takeover in their own internal communications, and as a consequence will shy away from that a little bit. And we need to be aware of that as lawyers. This guy worked for me, he was German, a number of years ago now, but we were acting in what was effectively a takeover transaction. There was a company that was at risk of going into liquidation. My client was prepared to purchase it for $1 to take on some patents and some other, and basically assume all of these risks. The company had about 30 employees, not a huge company. I'm struggling to remember what it did now. But it basically was big enough that it had a CEO, it had a CFO, it had a Chief Financial Officer, Chief Executive Officer, it had a head of HR, and it had a head of sales. So all of these people were, and a person who led the R&D team. All these people are really key to that business, and my client wants to acquire that business, its customers, its existing customers, and its intellectual property. But a lot of the intellectual property, particularly in a small business, it's in the heads of the people who work in the business. Often, that's one of the things when businesses grow that they really struggle with, is actually getting the information and the relationships out of the individuals and into the people around the table. So it's really important that those people come along. And actually, they had good people. So those people could have got jobs other places. Anyway, my lovely German associate, we're about to start with the due diligence, right? And we'll talk a bit more about what due diligence is and what's involved, but we're sort of trying to isolate what we think the key issues are that we're going to look at. So we've got effectively the equivalent numbers. So everybody around the table is kind of looking at the other person with their title, and even though the meeting's not about that, any reasonable human would know that they're thinking, am I going to get that job or are they going to get that job? Right? You know, it's not unreasonable. My client was roughly half as big again, but had more money. But they had better IP, right? So, like, it was actually not an unreasonable question probably for anybody other than the CEO, whose real question was, what is my job going to be? And the two heads of sales were effectively thinking, well, am I getting that job, or is that is the CEO or that other salesperson getting it? And my lovely associate, basically, first thing is in there and says, well, you know, clearly people are going to lose their jobs. And, you know, because we're taking over and clearly people are going to lose their jobs. And he was right up the other end of the table for me too. Bad call on my part because the guy had very little emotional intelligence, and there's just, the only way I could stop him was to get up and go around and really cut down. This is not what that meeting's about. But again, that's one of the reasons why we are careful with that language, right? Because it is not productive to a deal, and it's also not the stuff we want to get involved in. And frankly, at risk of outing my colleagues in the profession sometimes, there's two law firms in that transaction as well thinking, who's going to get the ongoing work? And that can be quite destructive, and it's something actually from an ethical point of view that we need to keep coming back to. But it is happening. Well, I can see you nodding there, Michael. You've seen that as a broker, right?
You can't pretend that ego and financial concerns and emotional issues don't come into these transactions.
No.
Even when it's a reasonably large business, it's quite interesting, and small business.
Yeah. And look, and it is interesting to me that those, so again, we'll get to due diligence more on, but often when we're thinking about due diligence is effectively the activity of working out what the problems are. And when we're working out what problems there are or there might be, we tend to use two factors for doing that, a qualitative and a quantitative factor. So in other words, we're working out, is this problem big enough for us to pay attention to it? Qualitative problems are pretty easy. We usually set a benchmark. It's usually about 5%. So, it's funny because we often stop at 5% and forget to think as lawyers 5% of what. So, but it tends to be 5% of whatever is relevant. So if this is going to cost more than 5% of the purchase price to fix, it's a problem. If our annual budget for this particular, or you know, the budgets that we've worked out for this particular asset or this particular group of employees is, if it's going to cost more than 5% to fix that, then it's probably a problem. So quantitative stuff is easy. So the qualitative stuff is the hard stuff, where it's like, actually, is this likely to have an impact on our ability to actually realise the synergies that we were looking for, or impact our ability to make the return on our investment that we budgeted for in some way. They are much harder, and they are the people things. But when you think about it, if it's a $5 million transaction, 5% is only $250,000. If it's a $5 billion transaction, it's $250 million. So actually, the emotional things, the quantitative things, actually can play out a lot more in a small transaction than in a big transaction. And the cost of finding out the small problems is actually higher than, so it can actually be quite awkward in that, and that's why it is difficult and expensive to buy and sell and to raise capital as well at the smaller end of the market, which is something we'll continue to talk about. A reverse takeover we'll talk about more as we go through, but this is a less popular these days, but a kind of a misunderstood type of transaction. It's also referred to, again, with the ridiculous terms, it's also referred to as a backdoor listing. So this is where an entity or a business, or investors in a business, I should say, that want to be listed for some reason are having difficulty or in getting listed, that what they do is that they sell their business to a company that is already listed in exchange for shares in that listed company, which results in those new shareholders becoming the majority owners. So, again, actually, I wonder if it's... Can I just draw that? I think it might make more sense for me to try and draw it on the screen.
Are we talking about backdoor listing?
Yeah, backdoor listing.
Very common with little failed mining companies that are still on the
Yeah, well, it's quite funny. You can see these companies that were mining companies that then became tech companies, that then became mining companies, and then currently they're tech companies because mining isn't so good. So,
And reflects the cost of actually IPO.
yeah, often. And yeah, there are lots of traps with them. So what you've got, actually, sorry, I'm just going to, I should have some blank slides that I can point to, but I can't. But just ignore my, right. So here we've got a business that, I'll just make it a circle so you can see it. It's a business that wants to be listed. There is another business that is already a member of the ASX and it has some shareholders. These guys, it has some shareholders as well. Effectively, so let's say that's 100%. What happens is this company will acquire that one, so it becomes a subsidiary. These people will cease being shareholders here, but will become the majority shareholders here. So say they now own 80% and that original shareholding is 20%. And so as a consequence, effectively this business can be traded. In theory, this is supposed to save you money and is supposed to make it easier to list. However, in reality, it can be significantly more expensive and again, they tend to be at the dodgier end of the market, to be quite frank. So in order to do this, to do a reverse takeover, so what you end up with is a change of control transaction here. So that means that we have to either comply with the takeovers regulations or we have to fit into an exemption. The exemption that we usually fit into is shareholder approval, which also means that because we're going through that exemption and we'll work through this is the introduction piece, remember, that these shareholders, there'll be some of these guys that have committed to the transaction in advance. That means that they're related parties and they can't vote in the transaction, which means that we will need to have majority interests addressed in and disclosure. Unless, the business that this company already held was pretty much the same as that business, then we've also got a significant change in the activities of the company. So we have to go through that regime. Also, unless the shares that are on issue and at the time and these new shares that are issued are trading at whatever price the listing rules say, and actually I haven't checked, but I don't think it's changed recently, that's 20 cents a share. You often need to do a share consolidation transaction here. They're selling at 7 cents a share or something. You need to do a transaction to do, say, we'll change every 3 ordinary shares you have into one 7-cent share into one 21-cent share. So you've got to go and do that transaction as well. And often you need to do a whole lot of disclosure. So it can be really, really expensive. And even still, the stock exchange basically has an overriding ability to say your business isn't the kind of business that we think should be on the stock exchange. So again, they tend to be at the dodgier end of the market. I'd love to say I've never done one, but I have done a few. They've often been quite a popular way for foreign-owned technologies to come in, particularly where they've basically got all of the infrastructure in place. So they've seen benefits in relation to that. And often when you've got an exploration company or some mining company, usually in WA, I think they're just people who go out there and sell them. They must make a lot of money doing it. But there are often people who are well and truly engaged in that process. Michael?
the only people who actually make money out of that are directors, because in reality, a lot of shareholders from the original company actually end up getting nothing.
Yeah.
All of the shares get split into whatever price,
Yeah.
to make up the 20 cents.
So, yeah, Michael said, so, and particularly if you have small number of shareholdings, there are rules that let them disappear. There's like mopping up of minorities. But also, well, look, actually, I have to say, as an investor, I have ended up having a couple of pretty good wins out of reverse takeovers many years ago now, sort of in the 80s. There was one small mining company that ended up taking over, an RTO was done for, I can't even remember what it was called now, but it was basically one of the first ISPs, Internet Service Provider companies, before people had the internet. But its main business, it ended up being able to spin in because its main business was cabling. So it provided coaxial cables, I think. Now, I actually had this dodgy penny mining stock that I had because I had it and I'd probably forgotten about it, and I maybe had $2,000 worth of shares sitting somewhere that had gone down to, $100 worth of shares, and I, didn't care about it anymore, and I just thought I'd lost my money. Hadn't done anything about it. There's an RTO, I'm ignoring the paper that comes in the post, or I might have even changed addresses from memory. Anyway, this company came in, the internet happened, it actually grew, it got taken over by somebody else, and then I got a very nice check in the mail when it got taken over a final time, because it had been mopped out that way. So there's definitely been successful ones. But I've got to say, I think they're few, and most investors who have been successful in them are lucky, because the investors who are paying attention when an RTO happens, they get out as soon as they possibly can, because usually when you've got a stock that's got a very low share price, it can be quite hard to sell those shares. So even if on paper they're worth a low price, worth something, this is my pain with my own company, Domicom. The price is so low at the moment. In theory, anybody can do the maths. I'm in the top 20 shareholders, so it's all on the public record. In theory, at 10 cents, I've got $300,000 worth of shares. Woohoo! But if I went to sell anything of substance, it would just zoom down in a moment. So it's not really worth anything. Which is a nice note to end on, with that scribbly, angsty piece on the slide, right? Due diligence, I've actually just talked about what due diligence is. Due diligence we will speak about a lot, and as lawyers involved in commercial transactions, that's often where corporate and commercial lawyers cut their teeth, is doing due diligence. That is changing significantly the way we do due diligence as a consequence of new technologies, and some of the tools that are available in deal rooms now are amazing. It's a really interesting question for the profession, actually, is how are we going to grow the M&A lawyers of the future? People like me, we cut our teeth basically reading documents, understanding the background in doing due diligence, and learning the transactions as they happen that way. A lot of the work that we did is automated now. It's done by robots. And I'm really interested in how this is changing. So you're, Billy, in a firm doing this work now. It was you, wasn't it? No?
Yep.
Yeah. I was thinking it was you. So it's you or Grace. I'm like, it's just getting confused by distance. I'll be really interested to hear, I'm sure we all were, about some of the things that your firm is doing and how. It's very similar to what's happening in discovery. Due diligence is just a sexy word for discovery for those of us who like transactions as opposed to litigation. Because people complain about due diligence, they say it's boring, and I actually love it. I am the world's biggest sticky beak, and it is one of the best ways to learn how something works, is to go in and look at how the business operates, how it's structured, what contracts it has, who the people are, what jobs they do. I find it endlessly fascinating, but I do get that I am rare. Disclosure, again, a term we've touched on a few times, fundamental to this area, and we use it in a few different ways. We use it formally and informally. In private transactions, due diligence and disclosure are well and truly linked. So again, depending on how the deal is structured and how it is insured, you will see more and more that in private deals, effectively the disclosure leads to the creation of warranties in a share sale and purchase agreement, and it effectively, risk is managed by the promises that are made and the disclosures that are given. So the buyer usually, again, depends on how it's structured, but the due diligence exercise is about them understanding the risk that they're taking and pricing that or insuring for it. In an investment sense, disclosure is a much more formalised sense. Now, I'm talking about public investment sense. So when you are purchasing shares via a stock exchange or investing in an IPO, the disclosure that investors get is through the public disclosures that the companies make, either through a disclosure document. That might be a prospectus, but it might be a range of other kinds of disclosure documents. And we'll be talking about different kinds over the course of the weekend. Disclosure is also something that the vendor will often do depending on the transaction. So vendors will be obliged in some cases to disclose interests that they have, the potential for conflicts of interest that they have, particularly when you have boards that sit across two environments or you have advisors that sit across multiple environments. And disclosure about funding can, particularly when we're looking at a leveraged buyout or any kind of transaction where the vendor is financing part of the transaction, we will be finding that there is both purchaser and vendor disclosure. Integration. Integration is a word that's often used in this context. It is really something that lawyers have very little to do with on the whole, which can be a shame. We tend to do, as I mentioned before, I like due diligence. We tend to put a lot of work into due diligence reports, and there's a lot of insights that can be gathered in a due diligence process that can in turn be moved towards bringing the two businesses together in a more efficient way. Often a lot of those insights leak because we tend to try and reduce costs and only report on problems. We often information about things that aren't problems or that are successes or ways that the purchase entity does something that might in fact be better for the whole of the organisation can often get lost. And so, and it's often a shame to see that. And there are many statistics, if you go and look at how successful are M&A, many people will argue that 5 years later that the cost wasn't worth the effort, that we should just grow our business ourselves because we have more control and ownership over it. But I think when the change or transition is managed well, you often see better results. And that's often comes through in that word, synergies.
There's an interesting study that was done on a future value basis, cash flows, and it actually showed quite clearly that...
Could you guys hear Michael? Yeah? Good.
There was a study, I can't remember the name of it, but it was very credible, where it showed that over 50% of all M&A deals globally destroy value.
Yeah. Yeah, no, and you'll find that McKinsey do that study, I think they do it every 2 years. Most of the big four consulting, I think all of the big four consulting companies will do it. The data that they take tends to be US based. Some of the mid-sized consulting accounting firms now are doing sort of mid-sized Australian based stats. Pitcher Partners do quite a good report, I think every 2 years. I have a feeling their most recent report was the beginning of this year, and I think they've done at least 3 of them. And that can be a good place to just go and have a look at what is happening in the Australian space, because mid-market transactions globally, you can still be talking up to $1 billion in the size of a transaction when we're talking about those numbers compared to global transactions. And Australia is its own market. We are more and more influenced, particularly in the capital raising space, by what's happening in the US. And there are some good reasons, I guess, for having standard approaches to doing the kinds of deals that we'll talk about across this subject. But Australia is its own market. We do have our own business culture. We do have, we are a long way from other places, which can make it less appetising for foreign investors to want to invest in small transactions here, because it's just a long way to come and have a look at what's going on if you don't have a significant investment. And so that means we have a relatively thriving local investment community, but it's not as probably not as strong as Silicon Valley or what you would see in the UK or in Amsterdam or in some of the other centres at the moment.